watching Big Brain Energy.
You might think that if you have more money to spend, you want to buy more stuff, but that's not always the case. This is because of something called income elasticity of demand, and this is what we're going to cover in depth today. This is the fourth video in our series on elasticity, where we cover everything you need to know for NCEA 3.3 Demonstrate Understanding of Microeconomic Concepts. Income elasticity of demand, or YED for short, is the responsiveness of quantity demanded to a change in income. So if you get more money, how much more you spend on stuff depends on income elasticity of demand. Before we get into how to calculate YED, there are 4 types of items that you'll need to know about. The first type of good or service is necessities. Necessities are essentials that you have to buy, for example, rent or electricity or petrol. You can't just not pay for these things, right? The opposite is luxuries. Luxuries are non-essentials that you don't have to buy. For example, eating out or going to the movies or going on holiday. These are things that you don't really have to buy, but they make you feel good. Note that luxuries doesn't mean Gucci handbags or Rolex watches. It includes those things, but it also includes simple luxuries, like going to the movies. Inferior goods are low-quality goods and services that people buy less of as income increases. For example, 2-minute noodles or frozen pizza or taking the bus. Inferior goods are things that you buy because you can't afford something else. You buy Pam's peanut butter because you don't want to pay for the nicer stuff, right? Or you take the bus because it's cheaper than driving. Naturally, when you get more money, you want to buy less of the stuff and more of the fancy stuff. Normal goods, the last category, are the opposite. They're goods that you demand more of when income increases. For example, coffee from a cafe, or eating out, or branded clothing. When you get more money, you'll want to buy more of this stuff. To figure out how to classify good or service into these 4 categories, we can calculate its income elasticity of demand. If the answer that we get is positive, then it will be a normal good, or if it is negative, then it will be an inferior good. If YED is between 0 and 1, then it would be a necessity, or if it's greater than 1, then it would be a luxury. Note that because all inferior goods are negative, we can't classify them as necessities or luxuries with this calculation. Alright, so how exactly do we calculate YED? Well, there are 2 main methods. The first is the percentage change method, where YED equals the percentage change in quantity divided by or over the percentage change in income. So the amount more or less that you buy over the amount more or less that you have. Let's do an example. Let's say that the quantity demanded of organic vegetables increases by 15% when income increases by 10%. Calculate the elasticity of income and state what kind of good it is. Well, the percentage change in quantity is positive 15 because it's increasing by 15%. The percentage change in income is positive 10 because income increases by 10%. 15 over 10 is 1.5, so YED is 1.5. Let's interpret this using our rules. In this case, YED is positive, so it's a normal good. Also, YED is above 1, so it's a luxury. And that's it. There is another way of calculating YED, and you have to know both for the internal. Method 2 is the midpoint method. It does look a little bit more complicated, but don't worry, we'll break it down. YED equals the change in quantity, so the new quantity Q2 minus the old quantity Q1, over the average quantity, so the old quantity plus the new quantity divided by 2. The brackets mean that you solve that many fraction first. Alright, then we take all of this and we put it over the same thing for income. So we take the change in income, the new income Y2 minus the old income Y1 over the average income. So Y1 plus Y2 over 2. And that's it, I promise. Let's do an example. Suppose the quantity demanded of instant ramen noodles increases from 900 to 1,000 units when income decreases from $30,000 to $25,000. Calculate the elasticity of income and state what kind of good it is. The new quantity minus the old quantity is 1,000 minus 900, over the average quantity, so 900 plus 1,000 over 2. Over the same thing for income, so the new income minus the old income, 25,000 minus 30,000, over the average income, so 30,000 plus 25,000 over 2. Alright, let's simplify that. The top half simplifies to 0.11. The bottom half simplifies to negative 0.18. 0.11 over negative 0.18 equals negative 0.61. Great, let's interpret this using our rules. In this case, YED is negative, so instant ramen noodles are inferior goods. Which makes sense, because instant noodles is something that people in general would probably buy less of if they were richer. Great, that's basically all you need to know. There are, though, a couple of tricks that can be useful to know. If income and quantity demanded are moving in the same direction, i.e., both are increasing or both are decreasing, then the outcome will be positive, which means that it's a normal good. So if income was increasing and you buy more of the thing, then it's a normal good. Or if income and quantity demanded are moving in opposite directions, i.e., one is increasing and the other is decreasing, then the outcome will be negative, i.e., it's an inferior good. So if income is increasing but you buy less of the thing, then it's inferior. All right, here's a full summary of all you need to know. Necessities are essentials that you have to buy. Luxuries are non-essentials that you don't have to buy. Inferior goods are low-quality goods and services that people buy less of as income increases. Normal goods are goods that you demand more of when income increases. If YED is positive, then it's a normal good. If YED is negative, it's an inferior good. If YED is between 0 and 1, it's a necessity, or if YED is more than 1, it's a luxury, noting that inferior goods can't be necessities or luxuries with this calculation. And then we have the two calculation methods, the percentage change method and the midpoint method. Your learnings are not complete without reinforcement, so let's do some practice questions. What does income elasticity of demand mean? Income elasticity of demand, or YED for short, is the responsiveness of quantity demanded to a change in income. What are necessities? Necessities are essentials that you have to buy, for example, rent or electricity or petrol. What are luxuries? Luxuries are non-essentials that you don't need to buy, for example, movie tickets or jewelry or takeaways. What are inferior goods? Inferior goods are low-quality goods and services that people buy less of as income increases. For example, 2-minute noodles or bus tickets or margarine. What are normal goods? Normal goods are goods that you demand more of when income increases. For example, eating out or vacations or organic fruit. Which of these items is a necessity? A Harry Styles concert ticket, an iPhone 18, or school uniform? The answer is school uniform. It's an essential that you have to buy. Which of these items is a luxury? A candle, mortgage payments, or socks? The answer is a candle. It's a non-essential that you don't have to buy. Remember, luxuries aren't just designer handbags, they're any item that you don't have to buy. Which of these items is an inferior good? Starbucks coffee, powdered milk, or a new phone case? The answer is powdered milk. It's something that people tend to buy less of if they have more money. They would buy fresh milk instead. Which of these items is a normal good? An aeroplane ticket, 2-ply toilet paper, or Pam's chopped tomatoes? The answer is an aeroplane ticket. It's something that people want to buy more of when they become richer. Thin toilet paper and canned veggies are things that you'd probably buy less of instead. How would you classify something with a YED of 0.2? It's a necessity, since it's between 0 and 1, and a normal good, since it's positive. How would you classify something with a YED of negative 0.5? It is inferior because it is negative. How would you classify something with a YED of negative 1.2? It is inferior because it is negative. How would you classify something with a YED of 1.7? It is a normal good since it's positive, and it is a luxury since YED is more than 1. Here are some calculation questions now. Suppose the quantity demanded of plane tickets to Bali increases by 10% when income increases by 5%. Calculate the elasticity of income and state whether it is an inferior or normal good. This question uses percentages, so we use the percentage change method, where YED equals the percentage change in quantity over the percentage change in income. In this case, the percentage change in quantity of plane tickets to Bali is positive 10, over the percentage change in income, which is positive 5. 10 over 5 equals 2, so the YED is 2, which is more than 1 and positive, so plane tickets to Bali are a luxury and a normal good. Suppose the quantity demanded of public transportation decreases by 10% when income increases by 15%. Calculate the elasticity of income and state whether it is an inferior or normal good. In this case, the percentage change in quantity is negative 10%, over the percentage change in income, which is positive 15. Negative 10 over 15 equals negative 0.67. YED is negative, so public transportation is inferior. Suppose the quantity demanded of Chamberlain coffee decreases from 1,500 to 1,200 units when income increases from $50,000 to $45,000. Calculate the elasticity of income and state whether it is an inferior or normal good. In this case, we've been given numbers rather than percentages, so we'll need to use the midpoint method. The new quantity is 1,200 minus the old quantity, 1,500, over the average quantity. So 1,500 plus 1,200 over 2. All of this over the same thing for income. The new income minus the old income, so 45,000 minus 50,000 over the average income. So 50,000 plus 45,000 over 2. Simplifying this gives us negative 0.22 over negative 0.11, and that equals 2. So Chamberlain coffee is a normal good and a luxury. Last question. Suppose the quantity demanded of Pix peanut butter decreases from 800 to 700 units when income decreases from $60,000 to $55,000. Calculate the elasticity of income and state whether it is an inferior or a normal good. In this instance, the new quantity minus the old quantity is 700 minus 800, over the average quantity, which is 800 plus 700 over 2. All of this over the same thing for income. So the new income minus the old income, 55,000 minus 60,000, over the average income. So 60,000 plus 55,000 over 2. Simplifying this gives you negative 0.13 over negative 0.09. This equals a YED of 1.44. So Pix peanut butter is a luxury and a normal good. Alright, this was the 4th video in our Elasticity of Demand series. Next, we'll be looking at how elasticity affects tax. If you found this video at all useful, please consider subscribing and hitting the like button. It means that we can keep making free educational videos for you. If you have any questions about what we've covered or have suggestions about what we should cover next, drop it in the comments below and we'll reply to you. See you next time for some more big brain energy.